Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is The Talking Point, and this is Monday morning. It is February 5th. Thank you for joining me. The market this morning is focused on, oh my goodness, when are we going to get a rate cut? Now, what's interesting about this is that the ISM, Institute for Supply Management Service Sector report came out just as I'm recording this call. And there was much optimism. In fact, the headline number moved just a tad above 53, which is expansion. Remember, the line in the sand is 50. Above 50 is expansion. And this is actually an important move higher for the ISM service sector. But embedded in that is commentary from business owners saying, yeah, we're pretty optimistic that, we're going to have rate cuts. Well, not so fast. This is important because the market overall has been talking about rate cuts. And in fact, the market is looking at March 20th as the initiation of a rate cut cycle. That's 44 days from now. Now, keep in mind, Chairman Powell was very clear at the press conference following the Fed meeting last week and just basically saying, it is not likely that we are going to have a rate cut in March. He was actually coming out, and maybe because he used the word not likely, then the market thought, well, maybe he means maybe, whatever. Surely there are scenarios in which we could have a rate cut in March. But I don't think they're ones that will be particularly positive. One would be that the economic data releases suddenly change course and become much, much weaker by the time we get to the March 20th meeting. And I can assure you that if it really got bad, the Fed doesn't need to wait for a meeting to cut rates. They would do it right away, especially if the market froze and broke. That means that liquidity has dried up. And I always say, for those listening, that when I look at and think about periods in which I've worked where liquidity has dried up, it's oxygen. That we need oxygen. The market needs liquidity. That's the market's oxygen. The Fed could come in between meetings to do that. But that's one scenario. The second scenario is, which is more or less the narrative that's the Fed is operating on, is that, look, we have a solid economy, and in terms of the labor market, remember the Fed more and more is talking about the labor market. Why? Because it's a dual mandate central bank. One is just about inflation and reaching its target of 2%. And the other is to have a backdrop for the labor market remaining healthy. So that he was talking about that, on last night, on Sunday night. And he basically was asked, by the way, and this is very important. He said to a question, he said, look, we are not waiting to cut rates until we hit 2% of our target. That's where you reach what they call price stability. No, he did not say that. He said, we want to make sure inflation is coming down towards 2%. And the reason for all of this, folks, is that the Fed doesn't want to make a mistake. They don't want to cut rates only to find out that inflation is creeping ever higher and that they may be forced to come in and raise rates again. That would be a policy error. But more than that, businesses, individuals would be making assumptions on, rate cuts coming and continuing to come if they cut rates early. And, then would be furious finding out that rates only were going to move higher. It changes the psychology. And obviously, psychology is an important part of inflation and deflation. Just to go over this again, in a heavily inflationary environment, we always say, buy it today because it's only going to be more expensive in the future. In a deflationary environment, it's, hold off, it's going to get cheaper and cheaper. Let's remember that. There is a psychological component in terms of retail spending and business spending. Now, Also, I want to point out that this week we still have a lot of companies coming to the market with their earnings reports. And a lot of them are smaller companies. And this is, I think, extremely important. One of the things we're looking at the market and the criticism in the market as well, it's such a narrow leadership. The Magnificent Seven has kind of been reduced to what? The Magnificent Four or Five now. And that if they're leading the market higher, it's not healthy. You need to have an underpinning in the market of other sectors, other companies leading the market higher, and also those small and mid-cap names. The small and mid-cap names, when they do well, it is predicated on a belief that the economic backdrop is positive. And so we're going to watch to see if this week that Russell 2000 can participate if we get a rally. Now, keep in mind also the market is overbought. And we always say in an overbought market, you are going to have to just consolidate those gains, pull back a little bit, nothing to be afraid of, but just allow the market to digest the gains. And of course, the catalyst is, it is the Fed saying, hey, don't think we're going to cut rates when you want us to. Let's listen to the army of Federal Reserve speakers that are out today, every single day this week. And remember that before the Fed actually met, the same group, these are the doves on the Federal Reserve, the Federal Open Market Committee, that's the rate setting committee, with the hawks and the doves with exactly the same message to the market. Hey, we're not raising rates until we're sure, and that may not be until the second quarter, and some even said maybe even the third quarter. It was orchestrated. It was a message like, don't push us because we're not going to do it until we are certain that we are getting closer and closer to our 2% goal. Now, we're going to hear one Federal Reserve speaker after another. Let's see if any of them deviate. Let's see if any of them feel compelled to say, no, I don't agree with Chairman Powell. I doubt it, but they won't do it that way. But some of them do go rogue. But if it's a unified, orchestrated message, that's what we're going to hear. And I suggest it's going to be exactly what Fed Chair Powell had to say last night. So in any event, this is what's so interesting. I would say 2 weeks ago, the expectations for a March 20th rate hike, the probability was still over 60%. By the way, now it's down to about 17% probability that we'll get one. And here's the interesting thing. May 1, that had been way up there in terms of probability. Now it's down to 67% probability. Now, needless to say, this is going to change between now and then. It's going to go up and down based on the data. Now, keep in mind, the Fed is data dependent, but so is the market. Also, I want to add here other things happening this week, just in terms of the economy. We're going to have the consumer credit report, and that is always interesting and important. So that's going to come out on Wednesday. But in addition to that, we are going to hear from the CBO. That is the Congressional Budget Office, and that's always an interesting headline because they're going to tell us about the budget and how we're doing with that, and also about the economy, their economic outlook. Chairman Powell made it very clear, by the way, in terms of the deficit. He basically said it's got to be fixed, that this is no way to keep going. I mean, he was very clear about that. And he could be clear because that's not the Fed's job, by the way. So also what we're going to focus on toward the end of the week, as we always do, are the initial unemployment claims. And actually, they were, fairly healthy last week. But in the report, I don't want to get into that payroll report. You all know what happened, but two things I want to mention is that the job growth was across the board. It wasn't just government jobs. It wasn't just government and healthcare jobs. When you hear folks talking about that way, it's almost as if they're not being paid and spending money. But it was broad-based. You had businesses hiring. You had every single part of the economy hiring. And there was one thing, however, in that report that I thought was actually worrisome. The number of hours worked was down. And that, a strong economy has the hours worked a full week of work. So we'll keep our eye on that looking ahead. And the other part of the story is that there are those who do not think that those numbers, because the government relies on surveys, whereas the ADP report, the private sector report that comes out on Wednesdays, showed a downtick in new hiring. And many people look at that report, the ADP report, is based on data. It's not based on surveys. It's based on what businesses are actually doing. So there is a view that somehow there's a disconnect between that really astounding number that came out on Friday versus what the ADP report had to say. Obviously, all of this becomes resolved over time because we get more and more information. So let's keep our eye on that. And again, one of the things that we're looking at this week, because we have some smaller companies, I'll tell you one other thing before we hang up that I'm going to watch. In particular, I'm going to look for PepsiCo that's coming out at the end of the week. Why am I paying attention? Because they have been very successful in raising their prices for their snack foods and obviously for their soft drinks. Coca-Cola as well. I want to see if they're continuing to do that. That'll be very interesting. Now, granted, they're smaller, but you want to see whether or not these higher costs are being pushed out into the actual prices. Because at some point, people say, well, you know what? I'll go get an off-brand. May not taste exactly like Coca-Cola or Pepsi-Cola, but I don't want to pay those higher prices. We'll see if even they are charging more. It's going to be important. In any case, have a very good week. Pay attention to the message sent by all of the Fed speakers, because as we know, when it's in unison, it is by design. And let's see if any of the Fed speakers actually go rogue. Have a very good, we'll be back next week. Thank you so much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.